The most dangerous number in the global financial system is not the price of Bitcoin. It is not the value of the S&P 500. It is the yield on the United States 10-year Treasury note. And yesterday, on December 3rd, that number did something that should send a shiver down the spine of every investor, every homeowner, and every CEO in the market. It broke out. Welcome to the Market Flash Special Report. I am your host, and today we are not talking about stocks. We are talking about the gravity that pulls stocks down. The enemy of all assets has awoken from its slumber, and it is angry. For 6 months, the bond market has been in a lull. It was a coiled spring, compressing, waiting for a catalyst. Yesterday, that spring uncoiled with violence. The 10-year yield shattered its accumulation pattern, slicing through technical resistance levels that have held the market together since the summer. We have hit a 6-month high. This is not just a chart pattern. This is a regime change. The bond market is the smartest room in the house. While the stock market has been partying on the hopes of a soft landing and rate cuts, the bond market has been looking at the math. And the math says the party is over. You need to understand the physics of what just happened. In finance, the risk-free rate, the yield you get for lending money to the U.S. government, is the force of gravity. When rates are zero, gravity is weak. Asset prices can float to the moon. Unprofitable tech companies, JPEGs of rocks, meme stocks, everything flies because money costs nothing. But when the 10-year yield spikes, gravity intensifies. It grabs everything by the ankles and drags it back to earth. What happened on December 3rd was a sudden violent increase in gravity. The mechanism is the discount rate. Every asset you own, whether it is a share of Apple, a rental property, or a crypto token, is valued based on its future cash flows discounted back to today. When the yield rises, the discount rate rises. That means the future money is worth less today. This is an automatic mathematical repricing event. It doesn't matter if the company had a good quarter. It doesn't matter if the CEO is a genius. If the denominator in the valuation equation goes up, the stock price must come down. That is the law of financial physics, and yesterday, the law was enforced. Why did this happen? Why now? The market had convinced itself of a fantasy. The fantasy was that inflation was beaten, the economy was cooling just enough, and the Federal Reserve would rush in to cut rates, flooding the system with cheap money again. The December 3rd breakout puts a bullet in that fantasy. The bond market is sniffing out something the stock market ignored: sticky inflation and fiscal recklessness. The data suggests the economy is not rolling over. It is re-accelerating. That sounds good, right? Wrong. In this context, a strong economy means the Fed cannot cut. They have to keep the boot on the neck of the economy to prevent inflation from flaring up again. We are moving from a pivot narrative to a no-landing narrative. A no-landing means no rate cuts. It means the cost of capital stays high. It means the higher for longer slogan that the Fed has been chanting is not a bluff. It is the reality for 2026. So, what is the immediate impact? We are witnessing the return of the king. Cash is king. For 15 years, we were told cash is trash. We were told you had to move out on the risk curve to get any return. That era ended yesterday. When you can get a guaranteed risk-free return of 5% or more by simply parking your money in short-term government paper, the bar for every other investment gets raised. Why would you buy a utility stock, paying a 4% dividend when the stock can drop 20%? You wouldn't. You would sell the utility and buy the bond. Why would you buy a risky real estate investment trust, yielding 6%, when you can get 5.5% with zero risk? You wouldn't. This is the sucking sound you are hearing. It is the sound of liquidity being sucked out of the stock market, out of the crypto market, and out of the housing market, and flowing into the safety of treasuries. This liquidity drain is the enemy of asset bubbles. Bubbles need air to survive. High yields suck the air out of the room. Let's talk about Main Street. Let's talk about the housing market. The 10-year Treasury Yield is the benchmark for the 30-year fixed mortgage. They move in lockstep. When the 10-year breaks out, mortgage rates rip higher. If you were hoping for mortgage rates to drop back to 5% or 4% so you could buy that house or refinance that loan, I have bad news. That door just slammed shut. We are looking at mortgage rates staying firmly in the 7% or even 8% range for the foreseeable future. This creates a lock-in effect. No one who has a 3% mortgage is going to sell their house to buy a new one at 8%. Inventory freezes, transactions plummet. Real estate agents, mortgage brokers, title companies, they are in for a long, cold winter. But the real danger is in commercial real estate. There are trillions of dollars of commercial loans that need to be refinanced in the next 18 months. These buildings were bought when money was free. Now, they have to refinance at 7% or 8%. The math doesn't work. The rent roll doesn't cover the new interest payment. This breakout in yields is the pin that pops the commercial real estate bubble. Watch the regional banks. They hold the paper. If the borrowers default, the banks take the hit. It is not just buildings. It is businesses. For the last decade, corporate America went on a borrowing binge. They borrowed cheap money to buy back their own stock, artificially inflating their earnings per share. It was a great magic trick. Now, the bill is coming due. We are approaching the maturity wall. Billions of dollars in corporate bonds are maturing and need to be rolled over. Imagine a zombie company, a company that barely makes enough profit to pay the interest on its debt. They survived because interest was low. Now, they have to go to the bond market and issue new debt at double the cost. They can't do it. They will face a liquidity crisis. They will lay off workers. They will file for bankruptcy. Yesterday's spike in yields is the bell tolling for the zombie companies. The era of capital misallocation is over. Only the companies with real cash flow and clean balance sheets will survive this environment. Let's look at the S&P 500. The equity risk premium, the extra return you expect for holding stocks over bonds, is now at its lowest level in 2 decades. You are not getting paid to take the risk of owning stocks. When yields break out, price to earnings, PE ratios must compress. A PE of 25 is fine when rates are 1%. A PE of 25 is insanity when rates are 5%. The market has to re-rate. We call this valuation compression. It doesn't mean earnings have to collapse, though they might. It means investors are no longer willing to pay $25 for $1 of earnings. They might only pay 8 TCers. If the S&P 500 re-rates from a 22x multiple to an 18x multiple, that is a 20% correction in the index, even if earnings stay flat. That is the risk you are holding right now. You are holding overpriced merchandise in a discount store. There is a deeper, darker force at work here. The bond vigilantes. Who are they? They are the collective market demanding a higher price for lending money to a government that cannot stop spending. The U.S. government is running massive fiscal deficits. They are printing treasuries like confetti to pay the bills. Supply and demand applies here too. When you flood the market with supply, new bonds, and the buyers, China, Japan, the Fed, step away, the price drops. And when bond prices drop, yields rise. This breakout is a vote of no confidence in the fiscal discipline of Washington. The market is saying, if you want us to buy this debt, you have to pay us more. This is a structural shift. It means that high rates are not just a policy choice by the Fed. They are a necessity to fund the government. Remember Tina? There is no alternative to stocks. Tina died on December 3rd. She has been replaced by Tara. There are reasonable alternatives. When you can get 5% risk-free, you don't need to chase yield in risky junk bonds. You don't need to leverage yourself into a rental property. You don't need to day trade volatile tech stocks. This changes investor psychology. It promotes patience. It promotes conservatism. The fear of missing out, FOMO, is being replaced by the joy of missing out, JOMO. Investors are happy to sit on the sidelines, earning their coupon, watching the volatility from a safe distance. So, what is your move? How do you navigate a world where the cost of money is rising? Strategy: 1. Liquidity is priority. Number 1. Do not lock up your money in illiquid assets right now. You want cash, and you want cash equivalents. You want to be able to move fast. If the market crashes because something breaks, you want to be the one with the dry powder to buy the wreckage. Strategy 2. Short duration. In the bond market, duration is risk. If you own long-term bonds, 20 or 30 years, rising yields crush your principal value. Stay short. Treasury bills, short-term notes, money market funds. Capture the high yield without taking the price risk of the long end of the curve. Strategy 3. Deleverage. If you have variable rate debt, credit cards, lines of credit, margin loans, kill it. Kill it now. The interest on that debt is going to eat you alive. Pay it down. Do not carry margin in a rising rate environment. The carry cost of holding a position is now higher than the potential return of many assets. Strategy 4. Quality over growth. In the stock market, rotate. Move away from long-duration equities, the unprofitable tech stocks that promise earnings in 2030. Move towards short-duration equities, companies that are printing cash today, companies with low debt, companies with pricing power, energy, healthcare, consumer staples. The boring stuff works when rates are high. Do not underestimate this signal. The breakout of the 10-year yield is often the precursor to a financial accident. It breaks things. It broke the banks in March 2023. It will break something else soon. We are in a tightening cycle that the market has not fully priced in. The soft landing narrative was a comforting bedtime story. The yield chart is the cold bucket of water waking you up. The enemy of your portfolio is not the bear market. It is the cost of money, and the cost of money just went up. To summarize, the chart is broken. The trend is up. Yields are putting a ceiling on stock prices and a floor under the dollar. This is a time for defense, not offense. It is a time to respect the power of the bond market. The tide is going out. We are about to find out who has been swimming naked. Make sure you have a towel. This is the market flash. Cash is back. Respect the yield.